price charts. Now tonight, I've got two special little presentations prepared to share with you. Now, if you go to look and see the recorded version of this class, it doesn't re-record these presentations in there. So if you wish to see these, you can go to YouTube and then look for the channel that's called Forex and CFD Education, and then look under the playlist for charts, and it'll have all those prepared presentations. I've also given it so you don't have to memorize it all. If you look on your screen right now, you see some handouts. There's one called Presentation YouTube link page. You just click on that. It's going to give you the link to go watch these other presentations. I've also given you two handouts. One called Reading Financial Charts. I've put together a nice little presentation of all the information about financial charts in this handout that you can download by just clicking the download button. There's nothing else you have to do. And you can keep it and use it as a reference guide. I've also given you the Introduction to Technical Analysis ebook from investing.com. This is not just a 10 or 8-page ebook. This is an excellent reference material that'll go over all the aspects of trading and technical analysis, the different types, indicators, chart patterns, everything that you need to know, and will serve as a reference guide for you for learning how to use things at a later time. So these handouts are only available during this live class. So please click on those little download buttons and download them to whatever device you're using, and then move them around at a later time. They're yours to use and keep and do whatever you want with them. Now, also in tonight's class, I'm going to use the term security. I might use the term asset. I might say Google. I might say the euro. I might say the pound. I might say Facebook. It's only not because we're talking about a particular instrument. It gets very, very boring just saying security, security, security over and over again. Okay. So I just kind of mix things up so it sounds more interesting for both me to say and you to hear. Similarly, I intermix the terms investing and trading. Okay. We're all here because we are traders. I know the difference between investing and trading. You know the difference between investing and trading. But I also mix up those terms in class because it just gets, again, very boring saying trading, trading, trading over and over and over again. Now, ultimately, the first question I seem to get asked every time I'm giving a seminar, a live seminar, or run into people in a new class, on the street, some people come in the office, whatever, they always want to ask me, should I buy or should I sell? What asset should I buy today? What should I sell today? Then the next thing they're asking me is, well, where will the price be later today? Where will it be an hour from now? Where will it be tomorrow? They'll ask me, what do you think, Google? Is it a good investment or is it a good trade? Okay. Now, wouldn't investing be easy if we knew the answers to these simple questions? But to be honest with you, I don't have a crystal ball and I don't have a Ouija board. Now, technical analysis sounds like it's a big complex term, but it starts out with one little thing, and that's called a price chart, because all technical analysis is done on price charts. And ultimately, we could call it simply chart analysis. So it's no secret that online trading can be performed more efficiently if you possess the necessary tools. And a good place to start is with charts. So whether you're applying fundamental, technical, or quantitative analysis, there are numbers, these are all different types of ways that we try to predict the movement of assets. Some traders focus on news, others on interest rates, others on economic variables, while others use charting tools and indicators to guide their trading decision. Now, however, no matter what your trading method, you'll need to know how to read a chart. Period. There's no escaping it. Now, you must crawl before you can walk, because no matter how you decide you're going to trade, no matter what strategy you're going to use, what trading plan you're going to use, what you're going to do. You ultimately have to look at a price chart, because I could tell you that the euro is trading at 112.97. It was at 112.92 a little while ago, went up to 112.99, went back down to 111.97, went up to 111.96, went over to 111.94, and back to 111.92. Can you repeat that to me? Or can you tell me what the euro actually did? Well, guess what? The only place you're going to be able to actually see this and visualize it is on a price chart. Because I can give you all those prices, I can write them down for you, but your mind can't connect them. A chart is simply a visual depiction or graphical depiction of all the price movement so that you can see it and understand what price is doing. And that's the basics of the chart. Now, a chart typically has several different display modes. The most popular in online trading today is known as Japanese candlesticks. Now, candlestick charts are most commonly used display method for indicating the price on charts. Now, when I started trading 45 years ago, they were hardly used. They've been around for a very long time, but they were hardly used because when you were charting by hand, it was quite time consuming to draw these candles. And we use bar charts. But with the advancement of computerized charting and HTML and Java charts, it seems like this became the buzzword for online traders. And they love candlestick charts, which is perfectly fine. Okay. They ignore the bar chart. So price can be displayed. Now, there are three general types of charts, and the rest of these, then from there, are variations on these three types of display modes. And the first and most simple are line charts. Now, line charts are a way to see price, but give you really no other information. This is a line chart. Okay. We can see that the euro US dollar, which is the chart we're looking at a 30-minute chart, is moving in a downtrend, but we can't see anything else about it. We can't interrelate price. We can't make any decisions. We just see the movement of price. That's it. It's too simple. Now, a simple line chart draws a line from one closing price to the next closing price. And when strung together with a line, we can see the general price movement of an asset over a period of time. From there, we go to ultimately my favorite chart, which is a bar chart. Now, for the three examples tonight, we're looking at the same exact chart for the same exact time, for the same exact asset, the same exact day. So this chart we're looking at is the bar chart that we just looked at here for the line chart. Same period, same everything. Now, with a bar chart, we can start seeing visually a lot more, or telling a story about price, which we couldn't see in the line chart. We can start to see common lines, common price points. We can see that, look at here, we can see prices moving down, and we can see the tops here, but we can see all the closes moving more together, giving us a downtrend. Here we can see a lot of the opens and closes, significantly important levels. Here we can see trending down, where on the line chart, we just saw these brief movements, but we didn't see any prices that were definitive. And we couldn't see how active that price is. See, here we can see the whole movement of that price in that time segment. We're starting to make some sense out of price. And this is what charts do, is they take, because price moves in random fluctuations. And charts take these random fluctuations and give it to us in some type of visual graphical format that our brains can make sense out of. So a bar chart starts out with each bar, you put a little dash to the left. You then put a dash to the right at the close. So in that chart, we were looking at a 30-minute chart. So at the beginning of each 30 minutes, we will put this little dash here. At the end of that 30-minute time period, we put the dash to the right. We would then go back and put a dot at the highest price that asset hit in that 30-minute period, and a dot at the lowest price that asset traded in the 30-minute period. And we would connect the dots together, and we would form a bar. Now, if we stepped up the ladder from the open to the close, that tells us we had a bullish segment. We can see the width of the bar, the length of the bar, how active that asset was in that period. If we step down the ladder from the open to the close, that was a bearish segment. And the bears were in control of the market. And again, we can see how deep that move went by the length of that bar. Now, we come to Japanese candlesticks. Now, what we see is lots of reds and greens on our screen. A candlestick uses the same exact information as the bar chart. It uses the open, the high, the low, and the close. Because that's all the information we have. So we put a dash across at the open of that 30-minute period. We put a dash across at the close of that 30-minute period. We put a dot at the highest level and a dot at the lowest level. We connect the dots to the dashes, and we connect the dashes to each other, and we formed what's called a candlestick. If the segment was bullish, that means we stepped up from the open to the close. We would fill this candlestick in today with green. Used to be in the old days, we would just not fill in the candlestick. So a white candlestick or an empty candlestick would have been a bullish pattern. If we step down from the open to the close, which was a bearish session, in the old days, we would fill it in with the side of our pencil and make it black. Today, we fill it in with red and make it red for the bearish session. But the fact is, it doesn't matter whether it's black, white, red, green. You can use purple and chartreuse. It doesn't make a difference. As long as you know which one is bullish and which color is bearish. So as you notice, candlesticks use the same information as bar charts. But the candlesticks are now red and green. And let's go back over to the red and green. And the thing is, our eye, we're human beings, and we react to reds and greens. But candlesticks have very little to do with the amount of reds and greens you see on a chart. Candlesticks are about the shape and the size of the body. This is called the body of the candle. These endpoints are called the wicks of the candle. So the body of the candle and the length of the wicks are what's important to us. See, like here, we see one type of candle. Here we see a completely different type of candle. Then candlesticks are about candlestick positions and patterns. What the candlestick is telling you, what the two candlesticks, the previous candlestick and the preceding candlestick, are telling you in relationship to the last candlestick. So they give you more information, but you have to learn a little bit more. You have to learn what a tiny body is telling you. You have to learn what a green candle followed by a red candle that's twice as big is telling you. You have to learn what a harami is and what a doji is. Okay, what a bullish and a bearish engulfing candles are. But once you do, and you can recognize these, this chart gives you lots and lots and lots of information and can tell you and help you decipher the marketplace. Hold on. My marker won't turn off. There we go. So although bar charts and line charts are quite popular, Japanese candlesticks and traditional patterns were introduced to the Western financial world in the 1990s. The popularity of candlestick charts has soared among online traders over the last few decades because of the highly accurate predictive features. Candlestick charts can play a crucial role in better understanding price action and order flow in the financial markets. So although the same four values are also found in bar charts, the bar chart uses horizontal lines on the side of vertical lines to project the open and closing, but a series of candlesticks on the chart can help traders identify the character of the price action more definitively. So remember, the open, the high, the low, and the close are always exactly the same. They don't change by chart type. They don't change by method. But the fact is today, it's so easy to use multiple charts that a lot of us, like I will use my bar charts for putting all of my lines on my chart, and then I'll go back and turn it to candlesticks. Because all you have to do is simply click up here, and we now have the bar chart. And here's our bar chart. And I can see and draw my lines on my chart, put my indicators, my moving averages on the chart. And then all I have to do is click on candlesticks and I've got my candlestick. So you can use both or either. It's completely up to you. Okay. Today's charts give you, sometimes I say they give us too many opportunities because if we want, we can go change all the settings on this chart and change everything we want to change. Okay. If we get to the point where it's just craziness out there. Okay. We can change. See, we can set the colors for our border. We can set the colors for our wicks. We can set the colors of the candlesticks. We can, like I said, we can have pink and chartreuse, orange and green. You decide what you want. You can decide to use opens and highs and lows and the closes. Okay. You can decide to use mean averages. It all gets too complex. So I don't use any of it. I just use the standard old method. I'm an old trader, so I use what was around in my day. And I think what happens is we just offered too many choices, and we get lost in all of our choices. But now we have our charting styles. Okay, so if you notice, there's lots of choices in different kinds of charts, but they're all variations. So like we saw the line chart. An area chart is simply a line chart colored in below. We have hollow candles or we have regular candles. Okay. So they're all variations of these three main types of charts. So once we have our charts, and one of the most important reasons we look at charts is so that we can interpret price action, so that we can look for patterns in price, so that we can put indicators on our price. Because no matter how you want to trade, no matter what style trader you're going to be, no matter what strategy you're using, you got to come back to charts because you may decide doing however you want to do it that Google's going to go up today. I don't care how you did. Maybe you got some private insider information. But how do you know that Google's gone up? How do you know where you want to put your stop loss? How do you know where you want to take your profit? How do you know that your buddy who told you the private information about Google didn't call 2,000 other people who called 10,000 other people who called 50,000 other people, and the market's already taken that in consideration and moved up before you ever go make the trade? You're only going to find that from a price chart. How are you going to find out when you want to exit the market? Because you see price moving up and up and up. Well, how do you know when the buying has stopped and the selling has started? I remember when I was a kid, my mom was a very industrious woman. I don't know where this thing came along with silver. But there was this thing that all these people start buying silver. You know, the gold ingots and everything had passed its time. For some reason, I don't know. In the U.S., silver started getting. People were buying up silver ingots, silver, little bars and everything. And they didn't look at price charts. They, my mom talked to her girlfriend. Her girlfriend told her it was going to go up. She went and bought it. She was going. I don't even know where she was actually selling it, but she was selling it somewhere. They were all calling each other. Well, none of them ever looked at a price chart. And I'll tell you, one day silver tanked, and they're all sitting there with drawers and jewelry boxes full of these silver bars that are worth less than, because nobody looked at a price chart. Nobody said, "Oh, we can watch that chart and we can see when it stops going up and it starts tipping down, so I can stop buying this stuff." No, they all want to get rich quick. But charts are the only way you're going to see this. Charts are the only way you're going to actually see real trading opportunities. Now, if you agree, and I'm not saying you have to, I believe in the understanding that price is random. Okay, none of us can really predict price. Price is just random movements of the market. But there are certain times that price starts moving in a non-random fashion. When price begins moving in that non-random fashion, we can then predict what price is going to do, but only in that short-term period. And these are referred to as uptrends and downtrends. These are the non-random times markets moving. And I'm not just talking about, we could say that this asset in this period was moving in an uptrend because it moved from here to here, but that's not a defined uptrend. That's just random movement as price was building. This was a downtrend. When we see this happening, we can do certain things because it becomes non-random. It starts making steps and it starts doing things that we can interpret. But you can only see this by looking at a price chart. Now, one of the most important things for us as traders is once we understand the different types of charts, and let's forget about the indicators and the oscillators, we need to understand how to use a chart. Okay, and one of the most complex, putting an indicator chart on any chart is pretty easy. No matter which charting service you're using, if you're using it on the platform, they're always going to have a boxes as indicators. And just go there and you click on the menu and you pick the indicator you want. Okay. Deciding whether you want to use candlesticks and how you want to set them up, it's easy. Deciding what asset you want to see is pretty easy. Using all the different tools are pretty easy. Putting them on your chart's easy. If you're going to use Fibonacci retracements, putting it on your chart is easy. Using it is a whole different story. Interpreting it's a different story. Putting text on your chart, putting arrows on your chart. All this is relatively easy, and every chart's slightly different. But one of the most complex things about using a chart is understanding time frames. Because as I said, for class, I'm using the Euro US dollar 30-minute chart. So it's showing us a price bar every 30 minutes. We're seeing the open of that 30-minute period, the close of that 30-minute period. We're seeing the high and the low for that 30-minute period. Okay. Now, if I were using, if you used a 1-hour chart, it would show you the open, the high, the low, and the close for that 1 hour. So if the euro, say, was trading at 111 at the beginning of that hour, and the end of the hour closed at 112, we would have seen that movement. Say it didn't have a high and low. It started as high, started as low, and closed at its high. Now, a lot of people say, if I break that into 30 minutes, I'm going to see the first 30 minutes, and then I'm going to see the second 30 minutes. But the fact is, yes, that's exactly what you see. But you might see that by breaking it down in that smaller time frame, that the first 30 minutes is when it reached all the way up to here, but it opened and closed down here. And the next 30 minutes, it reached all the way up to here and closed down here. So it reached the high, but ended up closing here. So you're seeing more each time frame that you use is smaller. You're seeing more definitive action, but your time frames also have to fit your trading methods. So one of the most critical areas in using a chart is understanding the different time frames. Because you see, right now we're using a 30-minute chart. If I'm going to click over here, and because price doesn't change, price is always the price. Okay. So if I click over here and look at a 15-minute chart, I'm looking at something completely different than what I just saw. Although the price has never changed, because each one of those prices is written in stone for every minute of the day. So at 11:59, this is what the price was. At 12 o'clock, this is what the price was. At 12:01, this is what the price is. Okay, how you're going to put it on your graphic depiction is different, but it's still the same price. So if we were to take that same chart and move it back to a 4-hour chart, it looks a whole bunch different. Actually, if you notice on this chart, we looked at the euro US dollar in a 30-minute chart, it looked like it was trending down. But now we can actually see that it's been trending up since the beginning of June. Tells us a different story. So it's sometimes hard for me to convey to you all the information about time frames. So I found this great little guy who does a good explanation of it, and I put together a short little presentation that's going to explain to you in an easy format what the differences in these time frames are and why you would use them. So let me share this little presentation with you. It's only a couple minutes, but it might help you with it because this guy does a better job than I can do.
Hey traders, a warm welcome to you. Okay, so we're answering the age-old question of what is the best time frame for both swing trading and day trading. I'm going to give you my opinion, the time frame that I specifically use for day trading, for swing trading, and I'm also going to give you the time frames that I know other traders use who are successful in currency trading in particular, and I also got another guy who I know trades very well in equities. I'll tell you the time frame he uses as well. Okay, so we've got a decision to make, right? If we're looking at time frames, obviously the higher out we go, we're getting way more time, but we're getting much less information about what's happened frequently. So, or recently, should I say. So A 1 month is every candlestick represents a month. A 1 minute, every candlestick represents a minute. And we've got tick, which we'll come to in a second. Let's just put that, make sure it's clear. It's 100 tick. So we'll come to that in a second. Right. So if we're, one thing, one caveat to say, guys, is that we always want to make sure that we know what the higher time frame is doing. So specifically if we're day trading, we want to make sure that we at least know what's going on a higher time frame. So whilst we're definitely not making our trigger decisions based on any daily, weekly or monthly time frame, we do have to glance at that. But with day trading, once we've done that, we shouldn't have to glance at that again for maybe another week because we're so actively involved in it every day, potentially that trade. So from a day trading perspective, I think the combination that I personally like is this. So I'm always going to look at the 1 day first. I need to see the daily just because everyone's looking at the daily. I think regardless whether you're swing trading or day trading, you've got to look at the daily. Now, do I have that up on my screens when I'm executing? No, I don't. I don't need to, but I definitely want to see where the trend is. I want to see where the big key levels are, key support, key resistance, fresh highs, what's happened after earnings, if it's a stock, what's happened, you know, all the stuff that I need to do. That's what I'm basing my initial theory on. I want to see that I'm aligning myself potentially with the trend or if it's a reversal, etc. So 1 day. Now, for me, this is where I pivot things a little bit. I will switch between a 15-minute and a 60-minute depending on what's happened. So if I prefer to use a 15-minute purely because I'm going to get a lot more information in the chart that I need. So I can get 3 or 4 days in, depending on what size screen you've got and how you're formatted. I can get 3 or 4 days in on a 15-minute chart, obviously depending on whether I'm trading a 24-hour currency pair or I'm trading a stock. A little bit of variation there, but I feel like I can see more what's happened intraday with a 15 minutes. A bit more detail that I like, because I like that detail. But if I feel that, that's not giving me what I need to see, perhaps with kind of come up in a different area, I'll flick to the hourly, the 60-minute, just to see kind of what we are on longer, get more days in there so I can see what's happened. Now, most of the time, you're going to find that that's maybe irrelevant. Now, especially if I'm in a short-term mode where I'm being very aggressive, I'm looking to kind of take stuff out within an hour type of trade, then the 60 minutes less important to me, because I'm looking where it's going to go over a 4 candle period in my 15-minute, and I've probably got everything I need in my 15-minute. If I'm kind of waiting for something different, then I'll go back to a 60. So I oscillate between those two. Now, the danger is, guys, is that you try and have too many time frames in. I've made this mistake myself. Like, for example, trying to have the 15 and the 60, just pick one. If you find the 60 is too much, it's not giving enough detail, go for a 15, and vice versa. Or maybe split the difference and go for a 30. Don't know why. I don't go for 30, but for me, it's kind of habit as well. 15-minute feels comfortable. I feel like I've got the information I need from that. Okay, so daily 15-minute, 60 if I don't feel I can get what I need from the 15, but generally 15-minute. Then this is where it gets a bit strange for me. I like like to look at the 5 minute because I feel that on an intraday, now these two are interchangeable for me, the 3 and 5 minute. I like to see what's happened over a 2-day period or a 1-day period all in one screen. So the 3 minute, the 5 minute, that normally gives me a couple of days that I can get a good clarity of what's happened yesterday. Sometimes I might be able to fit the third day, depending on where we are, if at the beginning of the day I've just started or whatever, but I can get a bit more clarity and see, okay, there's the levels, that's more important, right, okay. And specifically, I do have some setups that do utilize a 3-minute chart specifically. That's an odd time frame to use, and that's probably when you saw this, you were like, well, 3 minute, who's a 3 minute? But only because generally I have some setups for that. So I will default to the 5, and if I want to go to 3, I'll go to 3. So my default is going to be the 1 day, the 15 minute, the 5 minute, and then the 1 minute comes in when I'm pulling the trigger. It's specifically.
Okay, so as you can see, those time frames are quite important. Now, what he mentioned is what you're looking at on your screen. Now, if you notice right now, I'm looking at the Euro US dollar 4-hour chart. Okay. This 4-hour chart means every candlestick represents 4 hours. The open, the high, the low, and the close for 4 hours. So what we're looking at on this chart takes us all the way back to June the 10th. I mean, to May the 10th, and all the way today. So we're seeing is about a month's worth of trading on our screen. If I were to click this and move it to a 1-hour time frame, since we can't change the size of our screen, what we're seeing is a smaller time period. So on a 1-hour thing, each candlestick represents 1 hour. And so right now on this chart, what's visible to me is back to June the 6th. So we're seeing about a week's worth of trading. Because visually we're seeing, you need to know what period of time, not just what hour time frame you have for the charts. Your eye needs to know that, okay, I'm looking at a week's worth of trading. Otherwise, you could be looking at a year's worth of trading. If we go back and change this to a 15-minute chart, we're now only looking back to June the 12th, one whole day. And each one of these represents 15 minutes. So what we're seeing is we're now seeing what the asset has done just in the last day. If we go back to a 5-minute chart, now we're only seeing what it's done in the last few hours. So you have to understand, and you want to use a smaller time frame for your trigger. You're going to use the small time frame to decide actually what price you're going to use to enter the market. You want to use the 15 or 30 minute for making your trading decision, and the 1 hour or the one, I don't use more than 4 hours to to understand the environmental. Is the asset trading up or down in a long-term range? Because like I said, when we looked at it earlier, here we see the Euro US dollar is right now not trending at all. It's kind of just all over the place. If we looked at it in a 4-hour chart, we see that it's actually in a very nice, well-defined uptrend. So we only want to trade or consider an up trade or a long trade during an uptrend. We only want to consider a down trade during a downtrend. Only. You always trade with the trend. So you have to figure out what longer term chart, whether you can use a 1 hour, a 4 hour, or 1 day for your environmental decision. But this is the things that charts do for you. Now, there's things like chart patterns that we look at. Like you see here, I've got my triangle. You can see this beautiful triangle developed beginning of this month, and you see the breakout of the triangle and a perfect breakout from the triangle and an uptrend. I didn't make this up. This has happened to be on my charts from a week or so ago. I just showing you in this class. But this is a perfect trading opportunity using a chart. When a triangle is developing, you come to our class on chart patterns. But the only place you'd ever see this is on a chart. And when it broke out of the triangle, triangles don't give us directional signals, but we got the breakout, we got the breakthrough here, the retest, and then we got the full break. That's telling you this asset is breaking out and has the momentum to move this direction. In other words, it hit me on the back of the head and say, dummy, go open a buy position. And we would have made good money off of it. But you get this from your charts. You also use charts to put your technical indicators so that you can see what an asset's doing and apply trading strategies. So there's many ways you can use charts. But like I said, in our market today, candlesticks are about the most popular. So I'll share with you a little presentation explaining candlesticks a little bit better and how you might use those in your trading.
Candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to two simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and one or two tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, You could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning Doji Star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead.
So regardless of how you're going to trade, regardless of which chart you're going to trade from, regardless of how much you want to learn, regardless of what strategy you're going to use, you need to be able to put some basic lines on a chart that'll help you understand the markets. Because the old adage in the market is the trend is your friend. Okay, so you have to be able to put a trend line on your charts, because that'll tell you which side of the market you should be trading. And you also need to be able to put on what we call support and resistance. These are like an elevator. They're the floor below your feet and the ceiling above your head. Because no matter what trading decision you're going to make, you still have to find an entry point. You have to understand if the markets continue to have momentum. And you're only going to be able to do this using a price chart. And all traders should be able to read a chart, should be able to put 3 simple little lines on a chart, which are trend lines, support and resistance levels, and volume. And actually, just together, they make a trading strategy. But they are also the basics of trading. So whether you're using fundamental information, quantitative information, qualitative information, whether you're using scanners, no matter what you're doing, these reading a chart and putting some basic lines on a chart should be part of everybody's toolbox. And you shouldn't ever make a trade without having looked at these, because they're fundamental decision-making tools, or they're fundamental filters that will help you not make a bad trade. They'll throw out all those trading ideas you're getting and say, you can't make this. Don't make that. Don't do that. Because what we're looking for is really these filters that'll help us filter out all of our possible trades to only end up with the most high probability success trades out there. So on that note, I'm going to say goodnight to everybody. I hope you learned a little bit about charts and how to read them, how to look at them, and why they're important to you. If you want more information about charts, if you go to Legacy FX, www.legacyfx.com, you can there and learn, watch their videos and read all their information and try out their advanced charts all on your own and learn as much as you want. Set up a demo account and see how and start playing with the charts a little bit. Don't make any live trades. Just play with the charts. Start seeing what price is saying. Because if you think of your chart as your roadmap, forget GPS in the old days. We had roadmaps, and think of this as your roadmap. It will get you where you want to be without getting lost along the way. So on that note, I'm going to say goodnight to everybody. Thank you for joining us, and we'll talk to you again real soon. Bye now.